The key difference between active and passive funds lies in how they're managed. Active funds are managed by a team of professionals who actively select and trade investments, whereas passive funds track and replicate specific market index like the Nifty 50, Sensex, etc. Instead of actively picking stocks, they hold the same investments as the index they track, subject to tracking error. Let's delve deeper into passive funds. The most common type of passive funds visible in mutual fund industries are index funds. As the name suggests, they track and replicate an index. The index could be Nifty 50, Sensex, Nifty 500, etc. So if you have a passive fund that tracks the Nifty 50, it will buy exactly the same stocks that constitute the Nifty 50 and have the same weightage as the index. So instead of hand-picking stocks and choosing what to buy and what not, the fund tracks and follows what the index is doing. If say the Nifty 50 drops a stock and replaces it with another, the index fund will also do just that. So, will the returns from the index funds be exactly the same as index? No. There's something called as tracking errors that occurs in these funds. Tracking error means the extent to which the NAV of the fund moves in a manner inconsistent with the movements of the benchmark index on any given day or over any given period of time due to any cause or reason whatsoever, including but not limited to expenditure incurred by the scheme, IDCW payouts if any, whole cash not invested at all times as it may keep a portion of funds in cash to meet redemption, etc. Here are some of the biggest advantages of passive funds. First, relatively low cost. Since the fund is simply replicating the index, it does not have any large fund management fees as there's not much research or stock picking to be done. Second, lower human biases. Since it is aping the index, the risk of a fund manager going wrong is eliminated. Third, diversified stock exposure. An equity index represents a wide variety of stocks. Hence, the passive funds that tracks the index will also do the same, thus reducing concentration risk and giving its investors exposure to a large chunk of stocks. Passive funds are great if, first, you are a first-time investor and not sure where to begin. Second, if you're a little more conservative but still want to take part in equity markets. Third, for long-time investors. If you don't have a passive fund in your portfolio, consider adding one right away.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.